Hey guys, good morning guys. Money Smart here. How are you? Welcome back. Okay, today we're just gonna have a short video about funds. So specifically index funds, mutual funds, and ETFs or exchange traded funds. So what are the differences of these funds? Because if you're a new investor, it's gonna help you a lot to understand what are these funds, because it's gonna help you towards your retirement savings and your investment. Okay, let's start. Before everything else, just a disclaimer: I'm not a financial advisor, and whatever I'm saying here is based on my reading and experience that I always apply to my portfolio and investment that you can copy, or if you want to copy. Okay, let's start. So what's index fund? The first fund is the index fund. So what's the index fund? Index fund is just a pool of funds which copy and mimic an index. So when you say index, if you're familiar about Dow Jones, S&P 500, any pool of funds that mimic this kind of fund, I mean the S&P or Dow Jones, it's called index fund. Okay, so basically when you say index fund, it can be both mutual funds or ETF or exchange traded funds. So let's jump to mutual funds. Guys, mutual funds. So what is mutual fund? There's 5 key points that I want to discuss about mutual fund. First of all, it's an actively managed fund. Next is it's traded during closed market. Third is higher expense ratio, which impact your profit. And next is usually it's a segregated funds in a insurance. And next is hands-off experience trading. So first is actively managed funds. So when you say mutual funds, basically most of it is actively managed by a professional. So for example, Vanguard or RBC, big banks, they got some mutual funds. So with these mutual funds always tries to beat the market. So with this, as a result, they need to hire a professional who will manage the fund that will meet the expectation of that fund. So when you say expectation, it's usually to beat an index. For example, an S&P 500 mutual fund will with some professional will try to beat it. That's what mostly it's mutual fund. That's why in the next term, it's usually in higher expense ratio, because it's which will gonna impact your profits, because of course they're hiring a professional, so they need to pay the professional. So where they're gonna get the payment for that professional. So if the professional is trying to manage the fund, so the fees for the fund will be shouldered by the investor. So that's why this fund is a higher expense ratio, which will greatly impact your investment. And then one more thing, it's always traded in a closed market. So it's not like a common stock or an equity, which you can trade any day when the market open and before it close. When it comes to mutual fund, it's only traded one time. It is before close of the market. Okay, and then when you say mutual fund also, it's basically or mostly used also in an insurance. So if you got an insurance or a universal life insurance or any insurance, basically this insurance always tied up with mutual funds. So this mutual fund is gonna go in terms with which is called segregated fund. So what is segregated funds? Segregated funds are just a mutual fund which have a policy wrapped over it. Okay, so it's basically an insurance. So to maintain that insurance policy, they need a mutual fund which will try to combine with your policy. So there's a value with your policy, right? That's why segregated fund is. Next one is mutual funds. When you invest in a mutual fund, of course, what I said, it's usually managed by a professional, right? So when you try to buy a mutual fund, it's always a hands-off experience when trading, because someone is there for you to manage your fund, which you don't have to worry about. But take note, again, if you invest in a mutual fund, there's always a price for it. So there's always an expense for it, which is very high because you need to pay for the professional, okay? And the next one, what I'm gonna talk about is exchange traded fund. So what is exchange traded fund? So with exchange traded fund, it's much simpler. There's only 4 key points that I want to discuss about exchange traded funds. So the first one is it's a passively managed fund. It's traded like stocks, low fees, and more hands-on trading. So first key point. So what is it? It's a passively managed fund. So it's a complete opposite of a mutual fund. So in an ETF or exchange traded fund, it's passively managed, which means it only tries to mimic an index. So it doesn't have to beat the index, just like what the mutual funds are doing. It only tries to mimic the index. So whatever the result of an S&P 500 or a Dow Jones index or a high dividend yield index stocks, it's just gonna mimic it for an ETF. That's why it's passively managed. So there's a professional that's handling it, but it doesn't really affect it because it's passively managed, which means that it's just gonna copy whatever the result of an index. So it's not trying to beat it. The next one is, unlike with mutual funds, ETF is traded like a common stock or in a stock market. So you can trade it open and before closing of the market, which is very good when you're an investor. So you can pick whatever time of the market to buy in an ETF. The next one is, of course, it's low fees because it's passively managed fund. So you don't have to worry about impacting your profit when it comes to fees of ETF. Usually ETF got low fees, probably 0.02 or at least 1% because it's a passively managed. So no, it doesn't need to be the market. So it's got low fees. The next one is, the only thing about ETF is like a stock. So you're more hands-on when it comes to trading because no one's gonna look after your fund, right? Because there's a professional, but it's just gonna mimic the index. So you're more hands-on. So it's just like a normal stock. You have to buy it, or if you have to sell it, if you have to sell it because it's going down, right? I mean, these funds, the mutual funds and the mutual funds and the ETF, these funds are both long-term investment portfolio. So most of these, most of the fund have a dividend payout, that's why I advise investing in a ETF or a mutual fund. But for myself, in my portfolio, I always buy an ETF index fund. So because I'm a more hands-on investor, so I always look for an ETF which have low fees, and then it's more flexible because if I want to sell the fund, I can sell it any time of the day, unlike for the mutual fund. And one more thing, when you say mutual fund, it's more likely that you have to invest on a much higher cost or capital, because mutual fund is actively managed, so it requires more capital when investing. Not like with exchange traded fund, which is like a normal stock, then it's less capital you need to invest in an ETF. When it comes to ETF within my portfolio, I always make sure that the ETF got a high dividend payout. Not really high dividend, just got a dividend payout. So okay, in an ETF, if you're like a more hands-on investor, I advise you can try to buy an ETF index fund. Here in Canada, there's a lot of ETF index funds you can buy, but the famous ones are of course from the big banks like RBC. They got an ETF index fund. TD, they got an ETF index fund. CIBC, BMO, they all got ETF index fund. And one more thing is also a Vanguard. If you heard of Vanguard, so Vanguard is basically a company which is highly invested with mutual funds and ETFs. So they're also making some ETF index fund and a mutual fund. So if you search on the internet, there's a lot of index fund, ETF index fund you can invest in, which you can add in your portfolio if you feel that this index fund is suitable for your portfolio. Because if you're a beginner trader or a more hands-on trader, ETF index fund is really a good addition to your portfolio, because when it comes to an ETF index fund, it's gonna diversify your portfolio immensely, because of course in one fund, in one index fund, for example an S&P ETF index fund, it's already a pool of funds, which means there's a lot of company in it. That's why it's better have it additional to your portfolio, so you can be more diversified with your portfolio. Unlike if you're buying, of course, a single stock, which is like putting in one egg in a nest. When it comes to an ETF, you're more diversified. So if one company goes down, not all your portfolio will go down, because it's really diversified. So all different companies. But I'm not saying it's not good to invest in a single company. But if you're a beginner investor and you want to diversify your portfolio, then index fund, ETF index fund is the starting way. Okay, guys, that's all of it. If you like what I've said, and please like and share and subscribe to my channel, and don't forget to hit the thumbs up button, because it's gonna help a lot with my channel. Thank you very much. See you soon. Goodbye. Bye.